Um, Thank you, everybody, for taking the time to join us this morning or afternoon, depending on where you are. My name is Kevin. I'm the head of business development here at Kraken Futures. I'm joined by Gary, who's our head of exchange operations. Gary, do you want to say hi?
Hey, everyone. Thanks again for joining. Hope again you find today's session useful.
So today we've got same format as we've done the previous ones. So if this is your first time joining us, we're going to do about 10 to 15 minutes of prepared content. The goal of today is really to give everybody a chance to ask questions and really try to understand things. Gary runs the entire exchange, so he is the actual source of information for everything on Kraken Futures. So please ask questions in the Q&A box in Zoom. Please ask questions in the Q&A box on Zoom. To keep it smooth, I'll probably start answering the questions at the end of each slide. Otherwise, it can be a little bit jumpy for people that are watching. We'll try to get you out of here in about 30 minutes, or at least complete the content in 30 minutes. However, Gary and I will be around as long as necessary to continue answering questions. So don't feel like it needs to end at 30. We just want to be respectful of people's time. Today, we are going to talk about futures contract details. Let me close this fancy graphic. Today, we're going to talk about futures contract details. I have to leave this on the screen for a second. And today is actually probably the most important of the webinars that we're going to be doing because it's the guts of how the contract works. And it's very important to understand these concepts if you want to trade futures. I can tell you that the stuff we're going to discuss today is actually very poorly understood because some of these concepts are relatively unique to trading crypto futures. Most of the concepts that we discuss today will apply to pretty much every crypto exchange like BitMEX and Deribit. So please ask questions. It will be just general helpful knowledge for you. So let's start with futures in the first place. Traditionally, futures are used to hedge future cash flows. So farmers will use futures to lock in the price of a crop before they harvest it. Airlines use futures a lot to lock in the price of airline fuel or jet fuel before they fly. And cryptocurrency miners allegedly use futures to lock in the price of crypto, but to be honest, I haven't seen much actual evidence of that, either on our exchange or speaking with other large exchange operators. So in Kraken Futures, we have some traditional style contracts. They're called fixed maturity. We have 1 month and 1 quarter contracts for all of the tokens that we support. The way it works is these contracts expire essentially on the last day of the month, the last Friday of the month, and the last Friday of the quarter. So it expires at a fixed time each month and each quarter. You can always see the maturity date, and we'll talk about how to find that in the live trading interface later. So these are more traditional style futures contracts. We'll talk about how they work in a little while, but most of the volume in cryptocurrency trading today across all derivatives platforms is in the perpetual contract. And it's about 80% in most places. And the perpetual future contract tends to be the most popular for a couple of reasons. One, it's just easy to understand. It's spot price with up to 50x leverage. It's a pretty basic concept. The other thing that's nice is it never expires. So the fixed maturity contracts will expire at the last Friday of the month or quarter. The perpetual futures contract, you can leave the position open for as long as you'd like. And it's highly liquid. Because the majority of volume is in the perpetual contract, the bid-ask spread on $1 million is generally less than 20 basis points on our exchange. That means you can go in with quite high volume and not move the price very much at all. So it lets people go in and out with large size very quickly. So we discussed in a previous session that futures trade on a separate order book to spot, but they're designed to reflect the spot price. So, and to his credit, Arthur and the BitMEX team invented this. You need to create a way for the perpetual futures contract to stay in line with the spot price. Because technically it trades in a separate order book. Technically it's a completely separate product, but it needs to reflect the spot price. And the mechanism that most exchanges use today to do that, and we do as well, is called the funding rate. And the funding rate is a small fee paid by one side of the contract to the other to encourage the futures price, the contract price, to stay near the underlying spot price. It It is perhaps one of the most poorly understood concepts in trading futures. You'll see so many people talk about the funding rate as if it's a fee charged by the exchange. It is not. It is not on Kraken Futures, and it's not on BitMEX, and to the best of my knowledge, it's not on the other large futures exchanges as well. The funding rate is always paid by one side of the contract, like longs, to the other side, shorts, or shorts will pay longs. So when you see a positive funding rate, it means that longs are paying shorts. And when you see a negative funding rate, it means shorts are paying longs. The funding rate is calculated over a 4-hour period. But as a general indicator, you can kind of see if it'll be positive or negative just by looking at the relationship between the mark price, which is the contract price, and the mark index, which is the spot price. So in this case, the mark price is above the mark index price. The futures contract price is trading at about a $4 premium to the spot index. Because it's trading at a slight premium, we want to disincentivize people from being long and incentivize people to be short so that it moves the price down a little bit. And that's why you'll see a positive funding rate here. So the funding rate in this period, or this is calculating for the next period. The funding rate in the next period is expected to be a little bit positive, but that's a very, very small amount. It's 0.0021% per hour. Likewise here, you'll see that the mark price is slightly above the mark index price, and it's about $9 above or $8 above in this case. And that's why you'll see the estimated funding rate is, again, a very, very small amount, but it's slightly higher than the estimated funding rate in the next period. The way we do it is we take a snapshot every minute. So this won't be a perfect one-to-one relationship, but on average, it should hold. Please ask questions if you guys have questions about the funding rate. So the funding rate changes every 4 hours based on the activity of the previous 4 hours. So right now, we're calculating the funding rate for the 0800 to 1200 UTC period. And the funding rate that you're going to see right now on the platform was calculated 4 hours ago. It's dynamics in that 4-hour window. So we cannot predict the funding rate in the future. Beyond one, we can estimate what it'll be in the next 4-hour window, but we definitely cannot predict it more than 4 hours in advance. And it does tend to flip back and forth between positive and negative. It seems that the funding rate, I'll answer that question in a second. It's actually a very good one. The funding rate will flip back and forth between positive and negative, even in very bullish or bearish markets. It's just based on that 4-hour window's volume. But it does follow general trends. So if you average the funding rates over, say, a 7-day rolling average period, you'll begin to see that the funding rate will tend to follow the market sentiment. So in periods where the market tends to be bearish, this was 2018 when the price was going down to about 3,500, the funding rate was negative on average, which means that more people were trying to be, there was more, the price of the futures contract was falling below the spot price. And the system was trying to encourage the price up. So it was charging people a little bit more to be short and paying that fee to the longs. In periods where the market is bullish, the funding rate will tend to be positive because the futures contract price will be trading at a slight premium to the spot market, and the system will be trying to disincentivize people from being long and slightly incentivize them to be short. And somebody's asked a really good question here, which is that the funding rate was very, very high yesterday before the sudden drop. And that's true. What I think that was, again, down to markets. It was up entirely due to market sentiment. But I think what happened is people saw the price spike above $10,000 and they thought to themselves, if it can hold above 10,000, next stop is the moon. So everybody just started, there was a lot of buying pressure to go long, both in spot markets and in futures markets. And that increased pressure to buying drove the price of the futures contract up above the spot price. And that drove the funding rate up as well. So the futures contract price went above the spot index price and the funding rate became very, very high. We'll check what it is together in a few seconds. So funding rate could be seen as correlated with momentum. Yes, very much so. In any 4-hour period, it can go either way. But on average, if the market is swinging up, if we have a run to $20,000 over the next couple months, you will see the funding rate on average be positive because people will there'll be much more buying pressure and the contract will be trading at a premium to the spot price. And in times when the market's actually like, when the market is sort of ranging between two values, when it's just sort of flat, the funding rate will be very, very close to zero because the futures contract will be trading very much in line with the spot price. The perpetual futures is the same as the perpetual swap. I see on some exchanges, they call it the perp swap. Yeah, Gary might know, but BitMEX actually originally started calling it the perpetual swap. And I think there was some legal reason or regulatory reason why it is a bit taboo to refer to it as a perpetual swap. And that's why most exchanges have traded it to the perpetual futures contract. Gary, do you know the reasoning there?
Yeah, I mean, I guess it's perpetual swap and perpetual futures, because I guess there is in effect an expiry every 4 hours, but the position auto rolls and stays open. And that's how the funding rate mechanism works every 4 hours. So that's why it's a perpetual future.
But in practice, if you see a crypto exchange calling it a perpetual swap, it's effectively the same product as the perpetual futures contract. It's just another word to describe the same basic thing.
Yeah.
Is there a ticker to gain access to the Kraken Futures funding rate? So we actually have all of our historical data. So funding rate, trades, even liquidation assignments in a Dropbox folder, which maybe one of the guys can put into the chat. Gary, do you want to, and we can show it to you in the live website, but Gary, is there another place they can look at it?
Yeah, so there is that CSV, which is updated periodically. And then there is an endpoint you can hit to get this data, which we can share as well in the chat.
So we can keep talking about funding rate, but and we can always come back to it if there's questions. But let's also talk a little bit about basis in the fixed maturity contracts. Oh, by the way, the funding rate last year, we did a bit of the math. If you held a long position open for calendar year 2019, you would have paid about 12.4%. So the funding rate on average over the course of last calendar year was positive by 12.4%. So what that means is if you had a $100,000 or $1,000 position open and the price didn't change from January 1st to December 31st, you would have been 12.4% worse off than when you started. Now, the exchange doesn't receive that money. That money was paid to people that were short. So conversely, if you were short calendar year 2019, you would have received 12.4%. And one of the things we can show you a video of that is actually one of my favorite trades is you can actually just go 1x short. And on average, if it's a bullish market, you'll receive funding rate payments throughout the year. Your fiat value is locked in, and you'll actually receive 12.4% of your locked in value in Bitcoin. And there's no sort of, if you've hedged correctly, there's no sort of price risk. So let's talk about basis. So the price of a fixed maturity contract, so the monthly and the quarterly contracts, is basically just the market's best guess at what the price of the asset will be at the future date. And the basis is the difference between the current price today, the spot price, and the futures contract price. So said another way, the basis is kind of just the market's best guess at what the market will do between now and the expiration date. So if we look at the, I took these a little while ago, but if we look at the Bitcoin June contract on the date I took this, the mark price of the contract, so the Bitcoin contract price was trading at 9,286, and the mark index price, the spot price in that moment, was 9,237. So what the market was actually saying is between now, this whatever date this was, 36 days before the contract expired, between now and expiration date, we expect the Bitcoin price to go up by about $50. It'll be about a half. The premium is the difference between the two. So we expect the Bitcoin price to go up by about 0.5%. If we look at Litecoin, similar thing. So this is the June quarterly future, 36 days from expiration. The spot price at the moment I did this snapshot was $43.36, and the mark price was $43.21. So the market's effectively saying over the course of the next 36 days, we plus or minus expect the price to be equal and maybe a little bit down from where it is today. And same thing with Bitcoin Cash. So there's a spot price, $233, mark price, $235. So mark price is the contract price. So the market is saying we expect there to be a premium of 0.6%. So why don't I show you what it looks like in the platform, and then we'll talk about how you factor this premium into your trading activity. I know you explained before, but I can't understand why the mid price. So in most normal circumstances, the mark price and the mid price are going to be the same. And that one of them lags, sometimes just lags a little bit. I think it's the mark price lags slightly. The difference between the mark price and the mid price is that the mark price is the mid price bounded by the index. So these two are free floating, and this mark price is this price bounded by that price. So it can't, and what it's there to do is to prevent the contract price from going too far away from the underlying spot price. So normally it'll be the same. Why don't we look at the live platform now? And we can have a look. So this is the Bitcoin Perpetual. Let's look at our funding rate charge. It's 0.0047%. And the estimated next charge is 0.0017%. So looking at that, we would expect the current mark price to be trading at a slight premium to the mark index. And it won't be true every single second you look at it, but on average, it will be over the period. And sure enough, the mark price of 9,523 is trading at a slight premium to the mark index of 9,522. So this funding rate payment will slightly disincentivize people from being long and slightly incentivize them to be short. Let's see if any of these are trading at a discount. This one's kind of cool. So in Litecoin, the funding rate payment is extremely little, and it's because the price is more or less the same. So the spot price is trading almost exactly at the futures price. If they were identical for the 4-hour window, the funding rate would be equal to 0. So why don't we have a look at the September quarterly, because it's got a slightly larger, higher premium. So we're now looking at the Bitcoin contract, fixed maturity contract that expires on the last Friday, on the 25th of September. The current mark price, so the price Bitcoin is trading at today, is 9,517. And the mark price of the futures contract is 9,659. You can see mid and mark are the same at this moment. So the futures contract for September delivery or September expiration is trading at a 1.5% premium to the current price today. So the market's best guess is that, and the premium will be highly correlated across all of the futures exchanges. If it actually gets too different, people will arbitrage it very quickly. So what the market is saying is that our best guess is that on September 25th, the price of Bitcoin will be worth $9,659. It'll be a 1.5% price increase from today. So let's talk a little bit. Let's see if any of these have a bigger premium very quickly, just for fun. No, they're all about the same. Bitcoin's actually got the biggest premium right now. So you can scroll through here very quickly and see this number here will show you the premium that it's trading at. So you can very quickly see what the premium or discount is. So let's talk a little bit about how this might affect your trading activity. So one thing to bear in mind with the futures contract is that the futures contract price is essentially like, I think of it as like the over-under of what the contract price will be in that future date. And if the contract is worth less than that, you can actually lose money even if the spot price went up over that period. So let's take an example here of January 31st. We enter the current price of Bitcoin is $10,000. And we purchase a contract for March 31st expiry at $11,000. So we bought a 10% premium. It's important to note that this cannot happen in real life. I'm just doing it to use round numbers to show you. It actually can't be more than a 6% premium. So it would be impossible to see these numbers in the live platform, but I wanted to use big round numbers to show people. So you bought in at $10,000, and let's look at what the price is going to be on March 31st. So if the price on March 31st is $11,000, which was your contract price, your futures P&L would be 0 because you bought futures contracts worth $11,000, and that is exactly what they were worth when they expired. Now, if you'd bought the same amount, like on 1x long on spot, you would have made $1,000. And conversely, if the futures contract price, if the spot price on March 31st expiry is $10,000, the spot market would have stayed at 0. You wouldn't have made or lost anything over that period in spot because it started at $10,000 and it finished at $10,000. But since you bought the futures contract at $11,000, you would have lost $1,000. And same thing here. Spot price, if the spot price on March 31st is $12,000, the spot market would make $2,000 and the futures contract would make $1,000 because you bought in at 11 and it ended up being 12. So when I first started learning this, I would always ask myself, like, why would you ever trade the fixed maturity contract? And the reason why people do it, it tends to be two things. One is it's very, very predictable. So again, this example is not realistic. Let's look at the real world example here. It's very, very predictable. So you know that over the course of the next 114 days, it essentially costs you 1.5% in premium to go long right now if you hold it all the way to expiry. So it's actually whereas with the funding rate, it varies every 4 hours. You're never sure exactly what you're going to be paying over a period. And if it is a very, very bullish market for a prolonged period of time, the funding rate can end up being a little bit higher. Whereas with the fixed maturity contracts, you know exactly what you're going to be paying. So you will not, to hold a leveraged position open, you'll be paying 1.5% over the course of this time. And you know exactly what it is at the time of entering the position. So it's more predictable, and it can often be cheaper as well. So I use a very extreme example to show it to you here, but what we've done is we've gone in and taken the premium, looking back over the trailing 4 quarters, so Q1 2019 to Q1 2020, and we looked at the premium. So we assumed you entered at the average price on the first week of the contract, so basically the first week of the quarter. You buy in at whatever the average price was, so it's not about timing it to the first minute. So if you enter the contract in the first week of the quarter and you hold it for the full quarter until it expires, we looked at the premium over that period. And on Bitcoin, the premium was about 5.71% over those quarters. And on Ethereum, it was 6.6%. So this means if you had a long Bitcoin position open for that 12-month period, you would have paid 5.71% in the premium. The premium would have cost you 5.71% over that course of that year. But that is actually, relatively speaking, given the other options you have of 20% APR on margin, CFD broker that'll charge you 27%, that's actually a very, very inexpensive way to gain leverage in the space. And it's even cheaper than the funding rate, which was 12.4% over the course of the year. So when Bitcoin crashed in March, a great trade would have been a quarterly contract, as the max premium would have been 6%. Gary, is that right? Is that an accurate statement?
So I guess the question is, if you entered it in January on the March quarterly, but the quarterly price would have still followed the spot price, right? So it would have still potentially get, because if you were long, you would still potentially get liquidated. I'm not sure I'm following the question.
So one thing you can do, and it might be what this person is referencing, is that because you know what the premium is going to be, and we can do a demonstration. We actually have a video. We'll put together a video of how to do it. Because you know exactly what the premium will be, you can actually do an arbitrage trade. It's called a cash and carry trade. It's very common in traditional trading, where you go in and you buy Bitcoin. So let's say you've got $10,000. You buy $10,000 worth of Bitcoin on the spot market. You deposit that Bitcoin as margin in the futures wallet, and you go 1x short on the quarterly contract. What that will mean is that you've essentially locked in that premium. You've captured, because you have the spot, you have the Bitcoin at this price, and you're selling the Bitcoin at this price 114 days from now. So all you have to do is hold the Bitcoin for that period, and you will definitely receive the 1.4% premium, excluding trading fees, depending on how you get in and out. Now, you will have locked in the fiat value of your crypto at that time. So even if Bitcoin rises, you will receive 1.4%. And if Bitcoin falls, you'll still receive 1.4%. Good question. Open interest is the number of contracts in the platform. That is actually the next slide. So we can always come back to basics if you have questions, but let's keep rolling. So volume is the total notional size of contracts traded in the trailing 24 hours. One thing that is a common misconception with cryptocurrency trading if I buy $1 worth of Bitcoin and Gary sells $1 worth of Bitcoin, we each think we traded $1, but the exchange only counts that as $1 traded. So you see a lot of traders say, oh, I'm 2% of the exchange. And what they've done is taken their volume and divided it by the exchange's volume, when in fact, you'd have to divide that by 2. Divide your volume by 2 and divide it by, and then do the percentage. So volume is the total notional size of contracts traded in the trailing 24 hours. And open interest is the total notional size of outstanding contracts. So when you see open interest, that means in this snapshot, there are exactly $34 million worth of contracts long and $34 million worth of contracts short. There's always an equal number of long and short for the open interest. And the open interest is just, it shows you what, like the total outstanding. So it doesn't sum long and short. It's just Maturity is when the contract expires. So it only applies to fixed maturity contracts. It'll be usually the 25th or 26th of the month or quarter. So let's have a look at how you find that in the platform today. So we'll start with the Bitcoin Perpetual. Open interest on the Bitcoin Perpetual is $29 million. Volume will be $68 million. One thing that you can see is it's much harder if you're looking at exchanges. One of the dirty tricks some exchanges do it's very, very easy to increase your volume figure. We always have our numbers you can always rely on, but if we cheated, it would be much higher. It's very easy to fake the volume number with wash trading or any number of things. It's very difficult to fake the open interest number, or it's relatively harder. So what you'll see is there's a ratio between volume and open interest. And on most exchanges like BitMEX, Kraken Futures, it tends to be in the sort of 2 to 5, maybe 10x range. You'll see some futures exchanges that are quite obviously pumping their volume have a ratio of about 50 to 100x, where their volume is like $4 billion, but their open interest is only $20 million. So they're doing something funny with that relationship. Let's look at the September quarterly. Volume on that in trailing 24 hours is $4 million. As you can see, it tends to be much less liquid than the perpetual. And the open interest is about $3.5 million. So there's $3.5 million worth of people are long on the September futures, and $3.5 million worth of people are short on the September futures contract.
So, Kevin, if you look at so that September contract was obviously launched like last week, but if you look at the monthly, which was the previous quarterly, that will have a much bigger open interest.
Good.
On
that's
the
ETH.
that's ETH.
Sorry, that's ETH.
So that's still got 14 million. And what you'll see over time as that monthly contract comes close to expiry is the people that are in that contract will roll their position over to the new quarterly. So you'll see the quarterly should pick up a good portion of that open interest as the people with sort of longer term positions move them from one contract to another. And you tend to see that the quarterly has a bigger open interest than the monthly in general.
Why do I see the premium is minus 0.1% Bitcoin dollar for September in the online demo version? Yeah, it's a good question. So the demo platform is the order book in the demo platform is on the back end populated by 2 bots. One of the things I will try to do over the next couple of weeks and months is make the bots a little bit more lively. That's why it tends to just be sort of flat numbers. The spread here is like $5, whereas the spread on the live platform is almost never more than 50 cents. That's the minimum amount. It's almost always just pegged at 50 cents. But here it's about $5, and the price kind of just ranges pretty far in there. So the number calculates correctly. The problem is that on the demo platform, the premium will swing wildly because there's nothing keeping it in. There's nothing keeping the mark price in line with the mark index price beyond a very wide range. So for example, here the mark price is trading at a huge premium to the mark index.
Yeah, and you can see that is the max funding rate per hour that you would see. So that 0.05% is the max funding rate because the contract is trading at such a premium. But as Kevin said, this is not realistic. This is just kind of, fake orders in there.
Yeah, hopefully one of the things that we can do is make this a bit more, make the order book a bit more realistic, which will then make the funding rate more realistic as well. We can stick around as long as you guys would like to ask questions, please ask questions. I'm actually surprised by how few there have been given the complexity of the subject matter. But for those that do have to head out, in conclusion, the vast majority of trading volume in crypto futures is in the perpetual contract. It allows you to trade the spot price of crypto with up to 50x leverage. So the maximum difference between the price on the perpetual contract and the spot price is 0.5%, as Gary said. And if it ever gets that far, the funding rate will get quite high. When you trade the perp contract, you should be aware of the funding rate. And it's a small payment designed to keep the futures price in line with the spot price. And it will swing back and forth every 4 hours depending on market. It can swing back and forth every 4 hours. It's all entirely depending on market demand. When you trade the fixed maturity contracts, you should be aware of basis. It is the premium or discount that the contract is trading at relative to the spot price. Volume is the total amount traded in that contract in the trailing 24 hours. $1 purchase and $1 sold is still just $1 in volume. Open interest is the total notional value of outstanding contracts. $34 million in open interest means $34 million worth of long and $34 million worth of short. Long and short are always equal to each other. Maturity is when the fixed maturity contract will expire. Gary, is the max leverage same for all countries and also, let's say, all contracts as well?
So it's the max leverage is slightly different for contracts. I think the Bitcoin Cash one is slightly lower, but the leverage is set by your investor type, whether you're a retail or professional. It's not set on geography.
Tomorrow, I see a lot of questions. We're going to definitely take all of them. I just want to make sure people are wrapped in case someone has to run. Tomorrow, we're going to talk about trading futures. So we're actually going to review a lot of the concepts we've discussed today, but do it live in the platform and demonstrate the knowledge, demonstrate the things that we've covered. So we're going to go through what the order book is in more detail. We're going to do live demonstrations of market orders and limit orders and show you the impact that both have. We'll talk about fees and why you might want to do one versus the other. We'll do conditional orders. And we'll do order options. So these are maker only, reduce only orders options. So we'll show you how basically every feature and function of trading on the platform. So let's start going through some questions. We've done the max leverage. Can I close my position when I've gone for 1 month before the month expires? Gary, do you want to take that one?
Yep. You can close the position at any time you like. Then obviously you can choose which price you exit at. You don't have to wait for expiry. So the position can be closed whenever you like by placing an opposite order. Next one was, could you please explain once more how the funding rate affects your Bitcoin holding? Say we open a 1 Bitcoin perpetual contract long. How much will be deducted every 4 hours? Please give an example. Yeah, Kim, do you want to go to the platform? So if you look at this funding rate amount here, so this is how much you would pay per hour, the 0.047% on the size of the position. So if you had 1 Bitcoin to us, say it was 10,000, then you'd be paying 0.004% of that amount per hour over those 4 hours, for as long as the position is open.
So it's about 47 cents an hour if I'm doing my math correctly. On a $10,000 position. Yeah.
So if you close that position, you'd no longer be paying that. It's only throughout the period you have that position open, and it's kind of deducted in real time on the platform. So you see this unrealized funding column. Obviously, it's empty right now because there's no position open, but you would see that either accruing a deduction or a credit in real time, and then at the 4 hour period, that would then become realized funding, and then you would see an entry on your account log for the full amount. Where are you going to publish the recording of these sessions? Kevin, I think on social media.
So we're going to post it on YouTube and on social media, and so you'll see it linked in the Telegram. We're just doing some final edits on the videos right now.
Cool. And there's here another question. Is there a difference between the funding rate on the Kraken platform compared to other platforms?
That is a good question.
Yeah, good question. Yes, because each platform's contracts trade at different prices. So if you look at, let's say you see ours now is trading at the 9522, that will not be trading at the same as BitMEX or Deribit or any other competitor. I mean, it might be, but it's not necessarily going to be trading at the same price. You can see it's slightly off, right? So that's 9520. So it's $2 difference.
0.01%. and ours is, I think, 0.05.
Oh, this is a demo though. This is
Oh
right.
yeah, sorry. Why is it so high?
Yeah.
Yeah, ours is 0.0065. So ours is slightly less than theirs at the moment.
Yeah. So there will be the difference, and it also depends, I guess, on what index the platform's using. So obviously we use our mark index, which is the combination of 5 constituent exchanges. I don't know how many exchanges and which exchanges BitMEX is using, but there may be also some difference in the calculation, but obviously can't comment on what other exchanges are doing. Is the funding rate deducted from our real holdings on our futures account or from our open position? Say we deposit 1 Bitcoin on our futures account and use 10x leverage. Does the funding rate Yeah, so it deducts from the actual holding. So it will be deducted from your futures margin account. Again, we talked about those different wallets yesterday, about how in the holding wallet, those funds are not being used for a position and therefore not at risk, compared to the futures wallet, which all the funds in that wallet are being used as open position and are at risk. And it's from that wallet which the funding rate would be deducted.
So if you have any money in your holding wallet will not be affected by the funding rate as well.
Yeah. So if you maybe open a position, I came in just to show, you can go short or long. I guess either way, it's fine. So you should see funds being added now. You can see that this amount is going up. If you look at the futures wallet in the right hand side, Kevin, you can see that slightly going up. Yeah, over time. So it's been added to that. If Kevin had gone long, you would see it being slightly reduced. Obviously, it's more than in production because, as we say, it's at the max funding rate per hour because of the way that the order book is priced.
Yeah, please bear in mind, these are tiny detail differences. That's like 6 decimal places to the right of 0. Those numbers are moving.
Okay, now one question about the yesterday drop. There is a general belief that traders, bankers use the CME futures to go short and dump Bitcoin on stock markets. What is your take on that, and why everybody only mentions CME in this? Yeah, you kind of hear this a lot. I think why you hear it in CME is about CME specifically is because they're only taking dollars.
Gary, maybe can we read the question out loud because I'm not sure everyone is able to see that question specifically.
Oh, sorry, I thought I probably didn't read it out loud. So it's a question here about the drop yesterday. There's a general belief that traders / bankers using the CME futures to go short and then dump Bitcoin on spot markets. What is your take on that? And why does everybody only mention CME in this? I obviously can't comment on if bankers are doing this or traders are doing this where they're going short on CME and then dumping Bitcoin on spot markets. But the reason I think the CME is specifically mentioned is they only take USD as margin. And I think that people there, I guess, they don't have to be part of the Bitcoin ecosystem. So they're just putting in dollars and shorting it. Whereas I guess with a more, a crypto exchange, you're kind of putting in Bitcoin and you'll make your P&Ls in Bitcoin, right? So even if you short, you're still going to be holding more Bitcoin.
Yeah, just speaking anecdotally, I would be a little bit surprised if there were real trading firms actually doing that. So the firms that tend to trade on the CME tend to be more high frequency trading firms, like the Chicago high frequency shops. It tends to be people that are like hedge funds that are trying to get longer exposure, like the Paul Tudor Jones type people. There's every time the market moves dramatically, and especially in a downward fashion, people cry that it is market manipulation. And speaking to other exchange operators in the space, it is just as often panic selling and one guy that goes in and just market sells a big amount because he had it and he wasn't trying to manipulate the market. He just wanted to sell a lot that day. And then a bunch of other people respond and things can tend to cascade very quickly. So I think please take it with a grain of salt it's not to say it's never manipulation, but please take it with a grain of salt when people are always crying foul on a price drop.
Yeah, I would say also in general that I guess compared to other financial markets, that I guess crypto is slightly lower liquidity still. So when that one person comes in because to sell and that cascade happens, it happens a bit easier because there's maybe not as much liquidity as there would be in, more mature assets, I guess.
So this is a really cool question. So if I deposit 1 Bitcoin in our futures wallet and open a position with say 10x leverage, the funding rate that we will have to pay will be according to our initial futures account Bitcoin holding. No, the funding rate that you will pay will be according to the notional position size. So if you put $10,000, like 1 Bitcoin in $10,000, and you go 10x long, so you now have a $100,000 position, long or short, you will be making or receiving funding rate payments based on that $100,000 position size. It's always calculated based on the notional. And it'll be deducted or added to your futures wallet balance. So in this case, for example, we're 7x long. We're short $5,000, which is 7x leverage. Our funding rate payments, our unrealized funding rate payment is based on that 7x, this overall, this $5,000 position size. And it's being added and subtracted from our futures wallet balance of $616. We're obviously around to hang out as well, but if there are other questions, our Telegram chat is a great place to ask questions. We take a lot of pride in that. There's actually a very helpful community in there. And everyone seems to understand that this is pretty complicated stuff, and we're always there to help. And please try stuff in the demo platform. The nice thing about that is if you don't understand something, it's much easier to put a screenshot into Telegram or ask a question about it without revealing account information. So we always ask that you never put account information into Telegram, but if it's a demo screenshot, I think it's okay to share and ask questions. So we can keep this conversation going. Another really good question. Gary, do you want to take that one?
So I guess this maybe happens on other exchanges where there is a discrete at the end of the funding period where the payment is made. But on ours, as you saw from Kevin in that position on demo, the funding is paid out in real time. So as long as you have that position open, you will be either paying or receiving funding. And now if you close that position, now that funding that had been accrued as unrealized funding over that period is now realized. You can't actually see it on the UI. You can see it on the CSV when you download the
okay. Yeah, I'll do that later.
Yeah.
I don't want to
yeah. But you can see now that there's no more funding rate being paid, but there was throughout that period that Kevin had that position open.
And that's one of the things. There's a lot of nuance to trading on a futures exchange. So there are other exchanges where it's a discrete moment in time when all the funding rate payments, it's basically like you know what the payment's going to be, but in that moment, it sort of shifts the money very quickly across everybody. That can cause some interesting behavior because people will trade against that knowledge. We very carefully designed ours to be a continual payment over the course of 4-hour periods so that we think it's actually the best way to smooth the transfer between the two sides. Is it possible for the funding rate to switch from negative to positive and vice versa in the same 4-hour time interval? No. So once it's set for the 4-hour period, and that's what it'll be. So right now, this funding rate will be what's paid for continually throughout this 4-hour period. The next funding rate can flip back and forth minute to minute, but once the next period happens, so at 12 o'clock UTC, it will be locked in for that 4-hour period. Is there a way to watch yesterday's webinar? We will be putting them online. I'm sorry we weren't able to do it sooner. We're just going to do a few quick edits and then we're going to put it online. What time zone do you use for funding, Gary?
It's UTC. So it starts at midnight UTC and then 4 a.m., 8 a.m. So
please discuss scam wicks. I've been trading spot for years and have seen many instances when the price dramatically declined for a few minutes and probably triggers stop losses. Does this happen on Kraken Futures?
Yeah, a good question. I think so there's I guess a few things to discuss there is does it trigger liquidations, as you know everyone's going to be, or a lot of people will be trading at leverage, and also does it trigger stop losses? So as we discussed yesterday in the liquidation section, because we have the mark price, which is the futures contract mid price bound by the index price, so it can't deviate too far away from the underlying asset. That even if, and Kevin showed this yesterday, even if someone does a massive sell to bring the price down, that will not liquidate an account unless the underlying asset follows it, which, because it's only on the futures exchange, is unlikely. In regards to stop losses, so I think we'll go over this in more detail tomorrow when we talk about trading. But when you set your stop loss, you can choose what trigger you use. You can use a last executed price, or you can use the mark price, or you use the index price. So if you choose to use the mark price, it would basically be the same as a liquidation, where if someone does put some huge market sell or some huge market buy, that won't be triggered if you chose the mark price as your trigger. Now, if you choose the last executed price as your trigger, then obviously that would mean it would be triggered. But that's something you can choose when you place that stop loss.
All right. If there are additional questions, please put them into the chat. And Gary and I will be online on Telegram going forward. But just want to say from all of us here at Kraken Futures, thank you very much for taking the time to attend today. We really appreciate it. And we hope you'll trade with us. And at the very least, we hope we can help educate you a little bit about futures. Thank you very much. And we'll be on tomorrow at the same time. Thank you.
Great. Thanks for joining.